Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Danielle DiMartino Booth, who is the CEO and founder of QI Research. And so today we're going to have a discussion about the Fed. The Fed's recently made some moves, and so definitely want to get your takes as we engage in this conversation today. So the Fed recently cut by 25 basis points after some abysmal job revisions. And so I want to get your perspective there, especially since you study the Fed and you've worked with the Fed and such. And so I want to get your perspective there.
So, we're in interesting times. It's almost as if the impression that Jay Powell gave was that maybe I've got better information on the job market than the rest of the world, because when he was asked pointedly by a reporter, what about those revisions? What about the real-time revisions that we're seeing? What about the first negative print in payrolls, which was June of this year, that we've seen in real time in 15 years? He did not seem concerned at all, Jay Powell. Maybe seasonals are going to be in his favor going forward. We're going to have to see. That's kind of an inflation issue right now, but it was, I think the biggest takeaway really was Powell's lack of concern about the labor market, even though he definitely nodded to the changes. He acknowledged the changes. Obviously, they did the first rate cut in a year. But he really did brush off the magnitude of the downside that we've seen in the labor market as if he knew something that the rest of us didn't going forward, unless he has really strong views about inflation picking back up here in the very short term, the next few announcements that we get, because he called it a risk management rate cut, meaning this might be the first and last you see for a while. We don't know. We're going to remain very data dependent.
Yeah. Thank you. Thank you for sharing that. So just thinking about the revision in the job numbers, I interviewed you, I think it was last year, and you were saying we're in a recession. You were looking at the SOM rule, you were looking at the job numbers and everything, and then multiple analysts that were saying, yeah, I think we're going to have recession. And so to get this biggest revision, I believe it was bigger than 2008 when we
2009. Yes.
2009. Yep. And so what did that tell you? Was it just like, hey, we've been calling for this and we knew that this was the case?
Right.
What did that signal to you?
So, there are different ways to look through the many revisions that the Bureau of Labor Statistics puts out before the annual benchmark revision that gave us a prism into the magnitude of what we were going to see. And that's why we were able to make the call that job losses started in the second quarter of 2024, which they did. For which our clients are very thankful. But the fact that we had job losses begin in Q2 of 2024 means that we were in recession in Q1, because we've never had a time in U.S. history that the United States was not in recession prior to job losses beginning. The question now becomes, though, one of what's in the future. What do you see coming down the pipeline? So just to provide a tiny bit of context, that 911,000 nominally was the biggest number that we'd ever seen. We saw negative 902,000 in 2009. On a percentage basis, though, the revision that we just had, because we've had population growth over that long span of time between 2009 and where we are today, on a percentage basis, it was a negative 0.6% downward revision compared to the negative 0.7% one that we saw in 2009. So the 2009 one is technically, when you make adjustments for the change in the labor force and the change in U.S. population, 2009 is still the worst on record. Of course, that's the worst recession since the Great Depression. So you're close, but you're not quite there. But it's nothing to pat yourself on the back about. This labor market is this is the third straight year of deep negative revisions to payrolls. So you can parse the language, but because GDP revisions are made subsequent to payroll revisions, we won't know what economic growth actually was in those periods until we see the Bureau of Economic Analysis back the income out that was no longer part of the assumption because those jobs actually didn't exist, which means they put too much income into the GDP figures. So on average, it's in 2001 and in 2008, it took 5 quarters of GDP releases before we even learned, gee, that was actually a negative sign in front of GDP, not a positive sign. So that's going to be coming down the pipeline. But again, what clients want to know, what investors want to know is what's going to happen going forward. And we think that it's very feasible that we came out of recession around the election, that there was kind of this spurt of enthusiasm, and that we went right back in the first quarter. And indeed, Federal Reserve Governor Christopher Waller, whose name is still in the running to replace Jay Powell come May, when he looks at the job market through the prism of the private sector and what the private sector creates outside of the healthcare and education industries to kind of get to a core, he calls it the core private number, this economy has not created a single job since April. So we've seen downward momentum in the numbers, and we're seeing large employment sectors now finally succumb to negativity, mainly the construction sector. So we now know that we've had 3 consecutive months of losses in the construction sector. That's been kind of a holdout, if you will, because there was trillions and trillions of dollars of fiscal spending that went towards infrastructure and building chip plants that have been an offset to the weakness we've seen in residential real estate. But we've now seen that there's enough of a drag from housing that we are finally seeing job losses in construction. That should, with 87% of Texas home builders, 76% of Florida home builders laying off workers right now, we should definitely see continued momentum in that sector that had been kind of a pillar of support for the job market. And that's where clients are looking to see what happens tomorrow.
Okay. Yeah. Thanks for sharing that. So I like to connect all of the things we talk about to, just real life and Main Street, because that's ultimately who gets impacted by a lot of the things that are happening. And so I do a lot of work with college interns and high school interns, and I've been seeing just a really they've been having a hard time getting interviews. Multiple applications been put in, not getting, an opportunity or a call back. Many of them are not feeling that the job market is lucrative right now, and they're not feeling optimistic right now, especially just getting out of college and high school. And
Yep.
so are you experiencing or seeing that same sentiment from folks on Main Street?
I definitely am. I've got 2 in college right now, and I've got 2 high school seniors right now, and they're slim pickings, and we're seeing it actually play out in the data because we've seen a dramatic decline in the percentage of workers who are joining the workforce, which is a natural. It's a natural process after they graduate, or at least it's supposed to be. But we know, as Chair Powell said, we have a not hiring problem, not a firing problem as of yet. I think that that's not the correct conclusion. But to his point, this hiring freeze is really affecting younger workers. Yeah, we have college educated individuals coming out into the workforce. We have the highest unemployment rate for these young workers since we had in 1988. And in 1988, that was just a supply versus demand thing. All the baby boomers, that was the peak year of baby boomers entering the job force. There were just too many people. But right now, there's not enough demand. So it's not a supply issue, it's a demand issue. But this is having a real impact on the way young people not just perceive, gee, can I get a job? but it's how they're perceiving their futures. Because these very first years are critically important to these college graduates, and a lot of them are running straight into a brick wall.
Yeah, yeah, that's definitely rough. So the tariff issue, that's been debated on both sides a lot, and obviously with the issue of tariffs, like companies and private sector companies, they need certainty with how they project um, how they're going to perform or the revenues they project that are going to come in or whatnot. And so I'm just kind of wondering uh, about the private sector. You touched on it earlier, but many of
Mhm.
them are having a hard time planning around around how they're going to profit in the future because of the issue of tariffs. And so how much weight do you subscribe that to what we're experiencing now?
Oh, I think you're using the right word. It's very heavy for companies to not be able to plan. That's why, we just had a business roundtable CEO survey hit 24 hours ago. And even though some companies are now starting to sort of say, we're going to pick up capital expenditure spending going forward, you don't really know if that's because they're going to spend more because prices are up, which means it's going to come right out of their margins or not. Um, the flip side of it is we're still deep in recessionary territory in terms of companies' plans to hire people. And so you've got to get past those two big humps. You have to be able to plan for the future. If your margins are getting smoked, which we saw in the PPI data, in the producer price index data, we're seeing companies' margins really take a hit. Now, don't get me wrong. They've got a large margin cushion from having a few great years under their belts. But that does not help new entrants to the workforce if companies are going to keep these hiring freezes on. And by the way, you've got more than a quarter of the workforce now also in the United States. More than a quarter of the unemployed individuals have been unemployed for 27 weeks or more. And we label them permanent joblessness. And once you've been out of work for 6 months or more, it's even harder to get that next gig because you've become stigmatized by a potential employer as somebody who can't land a job. Why has this person been out of work for 6 months or more? And that's when we start to cross over this Rubicon. It's very hard for a lot of these workers to ever come back into the workforce. And that's why we call it labor market scarring. So it's not just new entrants to the job market who are having a really hard time. It's also people who lose their jobs and can't find another one.
Mhm. Are you seeing any tick up in some of the like kind of gig economy jobs? I've seen more people doing DoorDash and some of these contractor kind of jobs, and I've been seeing more of that just in my neighborhood and such. And so just wondering if there's any data on that.
There is. We've had more than 1.4 million full-time jobs have been lost since January of this year. And to the extent that that full-time job is lost, you have to replace your income somehow. And it's pushing millions of workers into the gig economy. But of course, they're not making driving for DoorDash or Uber or Lyft or as a contractor or as a consultant doing one-off projects here or there. They're certainly not replacing the full-time income that they've lost. And so again, these are things that begin to play out at the intersection of society and economics.
Yeah, yeah, for sure. So I was looking on your X page, and you've been tweeting about housing and such. And you mentioned earlier with housing construction and the issues happening there on the hiring and as well as the job market front. So does this mean that we're going to have less houses built, or is there going to? Do you think there's going to be a correction in housing? What are you seeing on the housing front?
I would say yes and yes. We had fresh information out earlier this week on the number of homes that are under construction in the United States today. That's dropped to the lowest level since the spring of 2021. So we're definitely seeing not just a fall off in the building of homes as well as apartments, but we're seeing ripple effects, and we're seeing that in companies that supply home builders. air conditioners, fire protection companies, they're seeing 40% drop-offs in volumes year over year. These are tremendous numbers, and the ripple effect keeps going to the extent that housing rate barometer for the broader economy, it really is having an effect on the transportation sector as well. If you're not building as many homes, you're not moving as many things around to build the homes or to put inside the homes. And you start to see that in furniture sales, just like Restoration Hardware told us last week. So housing is a big deal because of the tentacles that it has that affects other areas of the economy. So we consider it to be the most leading of leading indicators for business cycles. And we are seeing, I think according to Redfin, I think about 78%, or Zillow, 78% of the major metropolitan areas in the United States are seeing falling home prices already. So the correction in housing is without a doubt underway. And at the same time, we have a lot of government subsidies that are going to be running out at the end of September in terms of forbearance programs, FHAs. So we're seeing a lot more distress come out in government-backed FHA loans, and those are the people who tend to kind of have their budgets on a knife's edge and are most vulnerable for losing their home to foreclosure, to losing their car if they can manage to hold on to their home, losing their car to repossession. And we're seeing that, of course, play out in the delinquency numbers for U.S. households.
We've got 3 of the best porphyry copper targets that I've seen in the past 25 years of exploring for porphyries. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. We've put our foot on 2 outstanding projects in central British Columbia with copper and gold and some molybdenum in there. Our Poplar South project, we're drilling there at the moment, and I think we're on the verge of a major discovery. If you want to learn more, you can find us at vizslacopper.com.
So with that being said, last year when the Fed cut rates, people were expecting the interest rates on homes to fall. There's been an expectation of a refinance boom and things of that nature. And so the Fed recently cut rates 25 basis points again. And it looked like the long end of the curve actually went up a little bit. And so I want to get your take there on the long end whenever the Fed makes these moves.
So we've had yet another boomerang effect. Going into the Fed meeting, we were about 4.04% on the benchmark 10-year yield, where I think we're at 4.13% today. So we have seen a tick up in the longer end of the yield curve. I think part of that has to do with the whole idea of buy the rumor, sell the news. We had mortgage rates come down appreciably in anticipation of the Fed pushing through with this rate cut. And we had a massive wave of refinancing applications come through. I think refinancing applications were up 57% week over week. And then we had what we consider to be a hawkish rate cut. And again, that's Powell saying every meeting is live. I'm not convinced that the inflation beast has been tamed. There might not be more rate cuts going forward. And that's when you see kind of a backlash in the bond market and individuals presumably pricing out future rate cuts, which should not be reflected in the longer end of the curve. But it really depends a lot on how individuals are positioned going in. Our house view is that you should look for the 10-year to continue to be in a very tight range. And if the Fed is going to be stubborn about not lowering rates much more, and we're coming into the seasonally strongest time of the year for inflation to see upside, it's the seasonals that the statisticians pump into the data. Retail sales printed positive for the month of August. Without the seasonal addition to the numbers, it would have printed negative for the number of August. So be careful what statisticians are doing in the background with seasonality, especially coming out of a noisy economic era. But my point is, if the Fed's going to not be lowering interest rates to the extent that investors are hoping for, then you're going to see upward pressure on yields, and yields continue to be stuck like in a rut in the range that they've been in for months and months and months.
Yeah, yeah. I mean, that sounds disheartening, especially for those that are wanting to get into a home and such. And I know President Trump has been mentioning housing, and I'm not sure what his plan is to even try to address this issue that we're experiencing, where folks can't afford to buy a home, and then now we have issues of layoffs with construction, and we need more supply to uh, meet the demand and such. And so I'd be interested in seeing, like, what happens there in the future. So I do want to get your perspective. I know that you're into gold and such, and so I wanted to see if you had any perspective on gold's performance and with everything that's going on, economy, tariffs, trade, all of those different things.
So there are many ways to look at gold. Gold is the ultimate hedge in times of uncertainty. It is your classic hiding place so that you can protect your portfolio. Gold is considered to be a hedge against inflation. So to the extent that markets anticipate the Fed falling behind the inflation curve, so to speak, you're going to have more investors piling into gold. But I think right now, on a fundamental level, that the flows that we've seen into gold have been reflective of the central bank buying of gold on the one hand, and on the other, unmeasured, unprecedented levels of uncertainty. And that's what's pushed the inflation-adjusted price of gold to record highs.
Yeah, yeah, for sure. Yeah, it seems like I was thinking earlier, like, what are the risks for gold? Just as obviously, um, you know, folks have said in the past, like, okay, gold performs poorly in a higher interest rate environment. We saw gold this time stay resilient through that, and much of that was probably due to, like, central banks buying. Then now, Trump is pushing for a easier monetary uh, easier monetary policy and such. And so that's typically favorable for gold. And I know that the deficits as well as the debt and the spending just continues to increase, which is a tailwind for gold as well. And so, are there any risks for gold right now? It just seems like it's doing its job, right? And so, I'm
It
kind of
certainly
interested.
is.
There.
Gold is performing its duty right now. You characterize it very well, and I think the risk is really the risk in the broader markets. When we see gold sell off, you're usually going to see other assets selling off at the same time, and that means that people are actually selling their winners so that they don't have to necessarily liquidate their losers. Um, on a longer term basis, if the Fed does not ease enough, and you continue to see these job losses mount, and continuing claimants being really close to 2 million, you could end up generating a disinflationary shock if you maintain monetary policy too tight for too long. The Fed is likely blinded, in one sense of the word, by the fact that financial conditions remain as easy as they do. But Moody's came out with a report earlier this week that said we now have a record percentage of Americans who occupy the top 10% of earners responsible for 49.2% of consumption. We've never seen anything like this. We've never seen the inequality divide so in our face the way we're seeing it right now. But what that means, if you've got half of consumption accounted for by just 10% of Americans, that means that as long as the stock market is hanging in there, then you're not going to have an ugly recession, because half of the consumption is going to be supported by people being happy with their portfolios.
Yeah, yeah, for sure. So what are the risks right now with, well, you mentioned a deflationary shock if they keep monetary policy too tight for too long. Is that the only risk there? And then also want to know, are there any risks for a easier monetary policy? Because obviously Jerome Powell is concerned about inflation coming back.
So, I mean, to the extent that inflation again does print higher because of nothing more than seasonals going forward, because a lot of companies are saying that they're not rebuilding their stockpiles because they don't have the demand. In other words, the tariffs are out there, but if you're not paying for them because you don't have to rebuild your inventory, that's a different matter. Now, that does not apply to essentials. That does not apply to food, or to the extent that you have to buy clothing. But for discretionary type of goods, I think we're going to be seeing things go on sale, which is going to provide some downside. As far as the risks of the Fed becoming easier than what we expect, I think that would take a shock to the system. And let me be clear: when you have this few people entering the workforce, as we do, and people leaving the workforce at the same time, more than 11,500 a day, baby boomers go into retirement in the United States every day. When you have this imbalance begin to grow between a lack of new entrants and people exiting, you start to run the risk that that passive investing will become affected. And this is a big statement because passive investing has never been affected, ever. It's never been stress tested. But if retirees feel like the Fed's interest rate cuts are prompting them to start selling off their stocks, if we don't get enough contributions to 401ks at the same time because we don't have sufficient job entrance growth, then you could be having a whole different discussion about passive investing being tested, and that would certainly push the Fed if there was a shock in the risky asset markets. That would push the Fed to being in a much more of an easing stance than where they are right now, with just 2 25 basis point rate cuts priced in for the rest of the year.
Okay. Yeah, I can see that. So I've been noticing with some of the hedge funds and such. I was recently reading an article from the Morgan Stanley chief investment officer who recommended that folks have a 60-20-20 portfolio, and 20% of that being in gold. I was reading earlier where BlackRock is bullish on gold, considering the rate cuts. And then obviously Goldman Sachs has a target of 4,000 on gold for year end. So it seems like the big hedge funds and stuff are catching on to gold, and looking at, gold being the hedge as well. It seems like they are catching on to that, and that's maybe where they are pivoting, and that may show with the data on the gold ETF inflows and such. And so that's been something that I've been keeping an eye on as well.
Yeah, well, here's where the real Danielle comes out, because
All right, bring it out.
If nothing else, I will always be a contrarian. So I always get worried when the big sell side firms finally wake up after a monster rally and recognize an asset class. It's kind of like, oh, wait, private credit's in a meltdown. What do we do? Oh, I know, we'll sell it to retail clients. So the contrarian in me says be very cautious if some of the biggest names out there are setting price targets on gold when they didn't even used to include it in their asset allocation models.
Yeah, that is true. That's a good reason to be cautious for sure. So, well, Danielle, thank you for coming on the show, and appreciate you sharing your insights with us, especially just breaking down just this recent decision from the Fed and how this is going to impact markets and the economy and such. And so, where can people find more about you as well as connect with you? I know you've wrote a few books. You wrote Fed Up.
Yep.
And so where can people connect with you?
So we publish every trading day of the week. We publish the Daily Feather. Love to have you come join that community. DiMartinoBooth.substack.com. And if you run money and you're an institution, a family office, we have a full institutional lineup at QIresearch.com. And I'd love to talk to you personally about that as well. So, and if you don't already follow me on what used to be known as Twitter, please do so at DiMartinoBooth.
And no bots, you all, no bots. Okay. All
No,
right.
God help me with damn bots. Yes, no bots.
For sure. Well, you have a good day. Thank you for coming on. And everyone, be sure to hit the subscribe button. Thank you for joining us on VRIC Media today. You all have a good day.